Ever wonder why two people with the same salary end up in very different financial worlds, one struggling, the other thriving? According to a 2023 CNBC report, over 60% of Americans live paycheck to paycheck, even in high-income brackets. This begs the question, is financial freedom a fantasy, or just a mindset shift away? The truth is, most people don't consciously choose wealth. They settle for comfortable, assuming true riches are reserved for the lucky or the born privileged. But what if the only real difference between rich and poor isn't luck, but perspective? As financial educator Robert Kiyosaki puts it, the rich don't work for money, they make money work for them. This isn't just motivational fluff, it's a shift in mental wiring. Wealthy individuals approach life like strategic investors, while the average person is conditioned to trade time for money. Throughout history, from Andrew Carnegie to today's self-made digital entrepreneurs, one truth remains constant: those who build financial literacy, take calculated risks, and control their narrative tend to build lasting wealth. So what sets the rich apart? Think of it like learning a new language. The rich are fluent in the language of money, they analyze balance sheets as easily as others scroll social media. They understand that saving post-tax dollars is like pouring water into a leaky bucket. Instead, they invest pre-tax earnings, allowing their money to grow before the government gets a cut. Unlike the poor or middle class who often chase job security, the rich prioritize building businesses and assets that generate income long after they've clocked out. It's not magic, it's method. Ask yourself, are you operating with a scarcity mindset or a builder's mentality? Do you say, "I'll never be rich," or do you declare, "I'm going to be rich, and here's how"? Mindset isn't just part of the equation, it's the launchpad. If you believe your future is already written, you've surrendered your pen. But if you're willing to learn, adapt, and unlearn outdated financial advice like go to school, get a job, save money, you're already ahead of the game. Because in today's world, financial education is the new wealth gap. So here's your call: ditch the myth that wealth is a lottery ticket. Decide to play a different game, one where you're in control. Start investing in your financial education, take small, smart steps, and surround yourself with the habits and mindsets of the wealthy. Because yes, you can be rich. You just need to believe it and back that belief with action. Remember, formal education will make you a living, self-education will make you a fortune. Jim Rohn. Your future is created by what you do today, not tomorrow. Robert Kiyosaki. About the author. Robert Kiyosaki is a seasoned entrepreneur, best-selling author, and respected voice in personal finance education. Through his globally recognized Rich Dad series, he has written 26 books, selling over 27 million copies around the world. With a portfolio of successful business ventures, Kiyosaki has built an estimated net worth of $80 million and continues to empower individuals with the tools and mindset to achieve financial freedom. Key Takeaway 1. The 90-10 Rule of Wealth, Why the Rich Keep Winning, and How You Can. To imagine this, you're putting in long hours, budgeting every expense, and still struggling to get ahead. Meanwhile, a small slice of society seems to multiply their wealth effortlessly. According to the Wall Street Journal, just 10% of Americans own 90% of all stocks in the US. This isn't a fluke, it's a pattern. Across industries, from Hollywood to high finance, a similar rule applies. It's not just the 80-20 rule anymore, it's the 90-10 rule. A mere 10% of people are capturing the lion's share of wealth, influence, and opportunity. As entrepreneur Robert Kiyosaki and other financial experts suggest, the gap isn't just about income, it's about access and mindset. It's not your salary that makes you rich, it's your spending habits, Kiyosaki famously said. History echoes this truth. Philosopher Seneca once observed, "It is not the man who has too little, but the man who craves more, that is poor." The wealthy don't just have money, they understand and utilize systems the average person never learns. And more importantly, some opportunities are literally off limits unless you're already inside the club. Picture this: a young, ambitious man asks his wealthy friends to join in on their private investment deals. Their answer? No, and not out of greed, but legality. In the US, only accredited investors, those earning $200,000 plus or holding a $1 million net worth, can participate in elite-level deals. The best investments, the ones that yield passive income and generational wealth, are often gated behind regulatory walls. This creates a closed loop where wealth begets wealth, and the rest are left with scraps. So, where does that leave the rest of us? Should we resign ourselves to watching from the sidelines? Or, should we start thinking like the 10%? What if the key isn't chasing higher wages, but gaining financial literacy, investing in assets, and building value that grows beyond your time and energy? The path to wealth begins not with privilege, but with perspective. Are you ready to rewire your thinking, and your financial future? If you're committed to breaking the cycle and stepping into the strategies the wealthy use, now is the time. Start with education. Cultivate a mindset of ownership, not limitation. Like, share, and subscribe to stay empowered with insights that go beyond the basics, because the rules of money weren't made to keep you out, they were made for you to master. Key takeaway 2: Why saving money keeps you poor, and what the rich do instead. Work hard, save money, and everything will be fine. Sound familiar? It's advice most of us grew up hearing, well-meaning, but dangerously outdated. The truth is, following this traditional path to financial security may keep you afloat, but it won't make you wealthy. In fact, it keeps most people locked in the 90% of the population that holds just 10% of the world's wealth. The numbers don't lie. If saving alone created millionaires, we'd all be rich by now. Financial experts like Robert Kiyosaki have long challenged this narrative. Savers are losers, he says, not because saving is bad, but because inflation, taxes, and stagnation slowly erode what you set aside. Meanwhile, the wealthy buy businesses and build investments, understanding that the tax code and economic structure reward ownership, not employment. Employees pay tax first and invest what's left. Entrepreneurs invest first and pay tax on the rest, Kiyosaki emphasizes. The result? A financial snowball effect favoring those who play the game differently. Let's break this down with a clear analogy. Imagine two people each want to set aside $1,000. The employee has to earn around $1,300 to keep $1,000 after taxes, and then inflation and taxes on interest eat away at the savings. Meanwhile, a business owner spends pre-tax dollars on income-producing assets, then pays taxes afterward. It's not just about having money, it's about how that money flows. Financial freedom isn't about working more, it's about working smarter. And here's the kicker: being an investor is often less risky than being an employee. Surprised? Think about this: when companies lay off workers, their stock prices often rise. The job you depend on might be the first thing sacrificed in a downturn. But if you're a shareholder, you gain. The idea of job security has eroded in today's economy. Would you rather be a pawn in the system, or someone who owns the board? So, what's your next move? If you're serious about building wealth, start thinking like the wealthy do. Learn how to invest in assets, maximize tax efficiency, and create multiple income streams. Like, share, and subscribe if you're ready to shift from surviving to thriving, because your future shouldn't depend on a paycheck. Key takeaway 3: Assets versus liabilities, why most people stay broke, and how the rich think differently. Imagine this: you ask someone if their house is an asset, and they proudly say yes. But what if that asset is actually draining their wealth? According to surveys, a shocking number of people can't explain basic financial terms like debt-to-equity ratio or cash flow, and that's a problem. Because understanding assets and liabilities isn't just a finance geek's hobby, it's the foundation of building real wealth. Financial expert Robert Kiyosaki puts it bluntly: the reason most people struggle financially is because they don't know the difference between an asset and a liability. The rich never confuse the two. Assets put money in your pocket. Liabilities take money out, even if they look good on paper. That cozy suburban home with a $150,000 mortgage? Unless it's generating income, it's not an asset, it's a liability. Meanwhile, rental properties, dividend-paying stocks, or a cash-flowing business? Now those are real assets. Let's paint a clearer picture. Think of your finances like a garden. Assets are the plants that grow and feed you, liabilities are the weeds that choke your progress. Many people water their weeds, thinking they're nurturing growth. No wonder they're stuck financially. Mastering financial education means learning not just what sounds good, but what actually makes money move toward you, not away from you. Here's a question worth asking yourself: can you analyze whether a company is a smart investment based on its price-to-equity ratio or its debt-to-equity structure? If the answer is no, don't worry, you're not alone. But it is a sign it's time to upgrade your financial literacy. Without these skills, the investments of the rich will always seem too risky, when in reality, the real risk is staying financially blind. So what's your next step? Invest in your financial education. Learn how to read balance sheets, evaluate investment opportunities, and distinguish between assets and liabilities. It could be the smartest move you ever make. Like, share, and subscribe if you're ready to step into financial clarity and power. Key takeaway 4. Inside versus outside investors, how the rich create assets and control wealth. When you hear the word investor, do you picture suited-up Wall Street professionals or frantic traders yelling across a stock exchange? That's the Hollywood version. In truth, investing wears many faces, from quiet bondholders to tech founders quietly building empires from scratch. And while many dream of wealth through investing, few understand the real hierarchy that separates the wealthy from everyone else. Let's start with what we'll call the outsiders. Accredited investors are those who meet specific income or net worth benchmarks, think $1 million in assets or $200,000 annual income. They can access premium investment options, but they don't always understand them deeply. Qualified investors, on the other hand, have both wealth and knowledge. They're financially educated, capable of dissecting balance sheets and predicting market shifts. Yet despite their sophistication, both types remain on the outside. They own pieces of companies, but rarely influence them. Now contrast that with inside investors, people who create assets instead of buying them. These are the business builders, the real estate developers, the startup founders. Instead of passively buying stock, they generate wealth from the ground up. Their businesses become assets, living, growing machines that produce income and wealth. Isn't it more powerful to build the money machine than merely place a bet on someone else's? But here's where it gets even more strategic. Once an inside investor gains experience, she evolves into a sophisticated investor, someone who knows how to analyze external opportunities and leverage her inside knowledge. She understands tax codes, legal frameworks, and how to turn the system to her advantage. This is where the game changes. As Robert Kiyosaki said, the rich don't work for money, they make money work for them. So what does this mean for you? It means it's time to stop watching from the sidelines. Whether you're just beginning your financial education, or ready to embrace the investment strategies of the rich, remember this: you can learn how to become an investor from the inside out. Like, share, and subscribe if you're ready to stop renting your life and start owning your future. Key takeaway 5. Why starting a small business could be your fastest path to wealth. Imagine this: in the year 1900, 85% of Americans were business owners, farmers, shopkeepers, and craftspeople. Fast forward to today, and most people think starting a business is risky or unreachable. But here's the truth: building wealth through business ownership isn't just for tech geniuses or Wall Street elites, it's for anyone with an idea and the courage to act. As entrepreneur and author Robert Kiyosaki puts it, don't work for money. Make money work for you. In his childhood, Kiyosaki created a comic book rental business from discarded comics and a schoolyard audience, proof that starting a business doesn't require millions. It requires creativity and initiative. In fact, starting a business might be the only way for those outside the top 10% to access the powerful investments normally reserved for accredited investors. But how can I possibly find the time or money? You might ask. Here's the good news: you don't need to quit your job to start. Many of the world's most successful entrepreneurs launched part-time. Michael Dell built Dell computers in his dorm room. Jeff Bezos started Amazon from his garage while working a full-time job. Their secret wasn't luck, it was persistence. What if they had let fear or excuses win? Would the world even know their names? Starting small doesn't mean thinking small. A modest venture can generate cash flow, reinvestable profits, or even equity for future growth. Whether you grow it, sell it, or take it public, your business can become a launchpad into the world of real wealth. Still think building wealth is only for others? What hidden talents or passions could you turn into a stream of income? So here's your challenge: don't let outdated beliefs or fear of failure hold you back. You already have what it takes to take the first step. Like, share, and subscribe to the channel if you're ready to explore part-time business ideas, learn how to build wealth, and finally start your own business on your terms. Key takeaway 6: Why great businesses don't need genius ideas, just great leadership. Here's a surprising truth: Bill Gates didn't invent the software that made him a billionaire. He bought it. What he did build, brilliantly, was a business. This flips the script for anyone who's ever thought, I don't have a genius idea, so I can't start a business. In reality, you don't need to be a tech wizard, you need to be a visionary leader. As Robert Kiyosaki reminds us, the richest people in the world build networks, everyone else is trained to look for work. History agrees. Take Henry Ford, his mission wasn't to rake in profits, it was to democratize the automobile. That clear? purpose-driven vision gave birth to one of the most profitable companies in history. A spiritual mission is the compass that keeps a business aligned through storms and opportunities alike. But a compass alone isn't enough, you need a crew. No matter how talented you are, you can't be the accountant, lawyer, and marketer all in one. Building a business team is one of the most strategic moves any founder can make. Rich entrepreneurs know this: money spent on the right team isn't a cost, it's a multiplier. Just like a good investment, a strong team gives returns for years. And then comes the most important role, the captain. Leadership isn't about knowing everything, it's about empowering others. Think about it: would soldiers follow someone who can inspire them? Would your team rally around someone who lacks vision or decisiveness? Probably not. But here's the good news: leadership skills for business can be learned. Volunteer, step up in your community, take initiative, because confidence is built through action, not theory. So if you're wondering how to become a successful entrepreneur, start here, have a mission, build a team, and learn to lead. Don't wait for perfection. Don't wait for permission. Subscribe to this channel if you're ready to take that leap, and remember, you're not just capable of building a business, you're capable of building a legacy. Key takeaway 7. Why communication, not just strategy, builds wealth. Imagine pitching $1 million idea, and losing the deal because your delivery lacked confidence. Shocking? Maybe not. Studies show that over 90% of communication is nonverbal. Your words matter far less than how you say them and how you carry yourself. So if you're aiming for entrepreneurial success, here's an overlooked truth: your communication skills are just as critical as your business strategy. As Peter Drucker once said, the most important thing in communication is hearing what isn't said. Whether you're negotiating a partnership, motivating a team, or closing a sale, strong communication isn't optional, it's foundational. In fact, Robert Kiyosaki credits network marketing programs as a powerful way to learn this skill. Why? Because they force you to face rejection, fine-tune your pitch, and learn how to sell value, not just products. That's sales training for entrepreneurs at its best. Think of it this way: communication is like a currency. The better you are at using it, the more influence, and eventually income, you can generate. Want to persuade an investor? Rally your staff? Land a strategic deal? It all starts with how you show up. How to improve communication skills isn't just a nice-to-have, it's the secret weapon of every great leader. But here's the kicker: communication isn't just verbal. It's physical. Consider this: 55% of a speaker's impact comes from body language, while only 10% stems from actual words. That means posture, eye contact, tone, and attire matter, sometimes more than your business pitch. Robert Kiyosaki shares a moment when a bank hired a new president not for his resume, but because he looked and spoke like someone who could attract high-net-worth clients. The board ran the numbers, but his presence closed the deals. So here's your challenge: invest in your presence as much as your pitch. Join a speaking group, dive into sales training, and pay attention to your body language in business. Dress the part. Walk with intention. Speak with conviction. Because when you communicate with clarity and confidence, the world listens, and often, it buys. Key takeaway 8: How sophisticated investors build wealth while others work for it. What separates the wealthy from the rest isn't just money, it's strategy. Take two entrepreneurs running the same restaurant. One pays personal income tax, shoulders full liability, and hopes for an 8% return in a 401k. The other restructures into two corporations, reduces taxes, spreads risk, and leverages their income into diversified investments. Same effort, different outcome. Welcome to the world of the sophisticated investor. As Warren Buffett once said, risk comes from not knowing what you're doing. Sophisticated investors know exactly what they're doing. They understand how to reduce investment risk by controlling their corporate structure, mastering tax laws, and leveraging pre-tax dollars for maximum financial efficiency. For example, instead of owning a restaurant as a sole proprietorship like Bill and Jane, the sophisticated investor splits ownership between two corporations, one for operations and one for the real estate. This limits liability and legally protects wealth. Let's be real, most people are stuck in the hope and save model. Save $15,000 a year. Cross fingers. Pray for an 8% return. Meanwhile, the sophisticated investor diversifies smartly: some real estate, a business venture, and a hand-picked portfolio of assets. But they're not just throwing money around. They've built their financial literacy through real-world experience. They know how to evaluate deals, minimize taxes, and amplify returns. That's what sophisticated investor strategies are all about. Now ask yourself, are you working for money, or is your money working for you? That one question can flip your entire financial trajectory. Because working harder within a flawed system will never outperform working smarter with a better blueprint. Sophisticated investors don't avoid risk, they understand it, control it, and profit from it. Don't be average. Build your business, then structure it smartly. Educate yourself financially. Make your income count twice, once when it's earned, and again when it's strategically invested. Because the real game isn't just about making money. It's about learning how to multiply it. In summary. 1. In Rich Dad's Guide to Investing, Robert Kiyosaki challenges the conventional wisdom that simply working hard, saving money, and getting an education is enough to achieve financial freedom. Instead, he reveals that true wealth building comes from thinking and acting like the rich, starting with mastering financial education and investment strategies that most people never learn. 2. The core message is clear: financial success is a mindset, not a matter of luck or inheritance. Kiyosaki explains how the rich use their money differently, investing pre-tax income, building businesses, and acquiring assets that generate cash flow, while the majority remain stuck in the cycle of earning taxed income and struggling to save. 3. One of the most powerful takeaways is the distinction between assets and liabilities. Many believe their home is an asset, but Kiyosaki emphasizes that an asset is something that puts money in your pocket. Understanding this difference is foundational for making smarter investment decisions and avoiding common financial traps. 4. Kiyosaki also introduces the concept of different types of investors, from accredited and qualified investors who buy assets to sophisticated inside investors who create and control their own businesses and investments. Becoming an insider investor offers greater control, reduced risks, and more opportunities to grow wealth sustainably. 5. Through vivid examples, including his own journey starting small businesses as a child, Kiyosaki inspires readers to realize that entrepreneurship is not just for a select few. Anyone with creativity and determination can begin building businesses part-time and unlock doors to financial freedom previously thought inaccessible. 6. The book highlights the importance of leadership and communication skills in business success. From building teams to selling ideas and motivating others, these personal skills are vital for any investor who wants to grow their ventures and influence. 7. With practical advice on structuring businesses to minimize taxes and protect assets, Kiyosaki shows how sophisticated investors maximize their returns while mitigating risk. This strategic approach separates the wealthy from those who merely work for their money, encouraging readers to make their money work for them. 8. Rich Dad's Guide to Investing is more than just a financial manual, it's a call to transform your mindset, embrace education, and take charge of your financial future. It empowers you to break free from limiting beliefs and step confidently into the world of investing with clarity and courage. If this message resonates with you, please like, share, and subscribe to help spread this vital knowledge. And if no one told you lately, remember this: you are loved, you are worthy, and you are spectacularly capable of extraordinary things. I will leave with these questions. What's one asset you own that actually generates income rather than drains your money? How would your mindset change if you started thinking like a business owner instead of just an employee? Are you investing in your financial education as much as you invest your money? What fears or limiting beliefs are holding you back from starting your own business or investing boldly? How can you shift your focus from working for money to making your money work for you?